you, Kevin, and good afternoon, ladies and gentlemen. As an Englishman who has never lived in Japan, it is with some hesitancy that I address you today with my thoughts on the Japanese shipping finance sector and how it might benefit from internationalization. In self-justification, I can only say that I have spent the past 45 years observing and analyzing the shipping industry and its modes of financing, and that I've been visiting Japan and conversing with Japanese ship owners, shipbuilders, and banks for the majority of that time. If I have some criticisms to make and advice to offer, they do not imply that Japan's policies and modes of operation in the maritime sector have been notably worse than those in any of its competing countries. Indeed, in contrast to my own country, which managed to preside over the virtual complete destruction of its shipping and shipbuilding industries in the 1980s and 1990s, Japan can say with considerable pride that it still has 3 of the major shipping companies in the world and several world-class shipbuilding routes. But the economic, financial, and demographic challenges which Japan faces today have their correlatives in the maritime sector, and these in turn entail problems for the Japanese banks in relation to their domestic shipping finance businesses. My thesis today is that the very strong capitalization and low funding costs of the major Japanese banks give them an outstanding opportunity to dilute their exposure to domestic shipping risk through expanding their international ship lending in a disciplined way, just as the European banks are withdrawing from shipping finance on a massive scale. In many ways, Japanese shipping has been subject to the greatest structural discipline of any of its major world peers. British shipping companies, which rose to global preeminence on the back of the empire, withered and died as the empire collapsed, and 3rd or 4th generation shipping families proved unequal to the task of competing in a much tougher marketplace. Concurrently, the Japanese government was appraising the country's competitive position in world shipping and shipbuilding as connected aspects of a single strategic challenge. In the 1960s, the Japan Development Bank and the country's commercial lenders joined forces at the behest of the government to provide highly favorable financing for Japanese flagged vessels. But this would not have achieved its desired objective if the Japanese shipowning sector had remained highly fragmented. So in 1964, the Japanese shipping industry was reorganized under government auspices in order to stimulate recovery from the recession of the early 1960s. From this reorganization, the big 6 Japanese shipping companies emerged: NYK, Japan Line, Kawasaki Kisen Kaisha, Mitsui OSK Lines, Yamashita Shinihon, and Showa Line. Subsequently, as we all know, the depredations of the 1970s and 1980s shipping slumps would take their toll, and Japan Line, YS, and Showa would disappear. But NYK, Mitsui OSK Lines, and K-Line are still in the top tier of world shipping companies. More to the point, in the 1960s, the Big 6 were able to rebuild large modern fleets on extremely favorable terms, with the government showing a good deal of flexibility in the extent of the subsidies that it allocated to the program from year to year. Further support was provided to the Japanese shipping industry through a special relationship, the so-called Shikumizen, which developed in the 1960s and 1970s with ship owners in Hong Kong. This tied in the Japanese shipyards and charterers with the Hong Kong ship owners, most prominently YK Pao and CY Tung, to the benefit of all 3 parties, at least for as long as freight markets remained benign. The shipyards received an ever-increasing volume of orders, which provided a justification for continued expansion of yard capacity. Japanese trading houses and oil companies obtained the long-term use of tonnage operated more cheaply than under Japanese flag, while owners like Sanko and Japan Line were able to increase vastly the size of the fleets under their control without themselves having to undertake massive capital expenditure. Meanwhile, the Hong Kong owners, whose attitude to shipping was by and large more that of financiers than operators, managed to acquire enormous asset portfolios very quickly on the back of secure long-term employment, providing narrow but adequate margins of profit. The successes achieved by the Japanese shipping and shipbuilding industries in the 1960s and early 1970s were then put to the severe test of the global tanker crisis triggered in 1974 and then the broader shipping slump of the 1980s. As a major generator of shipping demand, both for imported energy and commodities and exported manufactured goods, Japan continued to provide a solid domestic base of business for its maritime sector. But low freight rates and high financial leverage combined to cause some high-profile corporate collapses, most notably Sanko and Japan Line. The subsequent evolution of the Japanese shipowning sector has seen the market dominated by the big three diversified companies, NYK, Mitsui O.S.K. Lines, and K-Line, but with a substantial group of second-tier owners, some of which are independent, some affiliated to the majors or to shipbuilding groups, and some subsidiaries of the trading houses. And finally, the substantial community of small ship owners based in the Seto Inland Sea area, whose investments in ships have historically been driven by tax considerations. From the point of view of the Japanese banks, which finance the country's shipping industry, the market has become highly stratified, with the big three corporates constituting the core borrowing universe at low spreads, but also having access to capital markets financing, and the rest primarily consisting of tonnage providers basing their business model and financing activities on medium to long-term charter cover. The big three companies have highly diversified operations encompassing scheduled liner operations, dedicated and tramp, tanker and dry bulk activities, and a variety of divisions and affiliates carrying on more specialized business lines which generally offer more earnings stability. They are major users of external financing and typically operate with quite high leverage, but they normally generate enough net cash flow to be able to service their obligations on time. But the great majority of the higher margin ship lending business in Japan is based upon the assumed credit enhancement characteristics of deals where a medium to long-term charter is in place. This charter could be to one of the big three, or one of the second-tier Japanese companies, or, and this has increasingly been the case in recent years, to foreign charterers, which are usually independent owner-operators rather than cargo exporters or importers. This, I believe, represents a fundamental flaw in the conventional Japanese domestic ship financing model. One of the first lessons I ever learned during the 1970s tanker crisis was that a charter is not security. It is a promise to pay, and like any other promise, it is only as good as the entity making the promise. This goes not just to ability to pay, but also willingness to pay. Most of the larger independent and small private ship owners in Japan are primarily involved in the dry bulk sector, where charter counterparty credit risk is a major problem. We have recently, as is well known, seen this exemplified in the Japanese market in a major way with the defaults of Daiichi Churo Kisen and United Ocean Group in the domestic sector, and Western Bulk and GMI among foreign charterers. Medium to long-term time charters are always at risk from material changes in prevailing levels of freight rates. Most commercial operators are relatively thinly capitalized, and they are therefore unable to absorb substantial negative cash flow for even a limited period of time. But even major charterers, steel companies and trading houses, will often use material adverse changes in freight rates as a justification for renegotiation or repudiation of charter obligations. It is therefore unrealistic to view such charters as anything other than an indication of daily net revenue in normal market conditions, effectively an assurance of full utilization at the stated rate, rather than an underwriting of income in adverse market conditions. The biggest mistake of all is for a ship owner and bank to take the existence of a time charter as a justification for higher leverage than would be acceptable on a charter-free basis. Experience showed amply throughout the 1970s and 1980s that charters which were supposed to provide guaranteed cash flow simply evaporated when the going got tough. The problem in Japan is that high leverage linked to contracted cash flow from time charters has become the basic business model for ship lending in the majority of cases. The classical triangulation model adopted by the smaller Japanese ship owners represents the extreme case. Here, tax depreciation is often a major driver of the deals, and a relationship with local shipbuilders is also an important factor. Most deals have involved new buildings, which are owned by the local owner on the basis of a small equity investment, typically 10%, but often lower, sometimes nothing at all. The vessel is chartered out for anywhere between 5 and 15 years, which theoretically offers an eventual opportunity for capital appreciation upon charter expiry. But the charterer often has an option to purchase, which will be exercised when asset prices are high, thereby expropriating the owner's chance of realizing an attractive asset play. Typically also, loan financing has been in Japanese yen, exposing the owner to an unhedged foreign currency risk. Highly leveraged ownership and financing structures of this type are ticking time bombs, which carry a high risk of explosion during freight market down cycles. How the major Japanese banks with a significant exposure to the shipping industry choose to respond to the current challenging environment will be of critical importance to their future role in financing the shipping industry. For some of the major institutions in this country, shipping finance has been carried out in a somewhat uncoordinated and decentralized way, arising out of important relationships with the big three shipping companies and the major trading houses, rather than being the result of a deliberate shipping finance strategy. This has resulted in an overwhelming focus on the domestic market and a lack of consistency in the appraisal of shipping risk. Financial stress, which is now permeating substantial sections of the Japanese shipping industry, leading to significant loan losses, may therefore cause these banks to pull back from shipping finance, in much the same way as several European banks have reduced their exposure to shipping or decided to abandon the sector altogether. These include major lenders to the shipping industry, such as HSH Nordbank, Commerzbank, and Royal Bank of Scotland. However, there are some Japanese banks which have viewed shipping as a specialized form of financing, requiring a more rigorous and focused approach, and which have also recognized that sound lending policy can only be based on an understanding of the global supply and demand picture. Banks such as Sumitomo Mitsui Banking Corp. And Sumitomo Mitsui Trust Bank have established shipping finance operations in Europe in order to internationalize their portfolios and dilute their exposure to the domestic market. SMBC has made most progress in this direction, and its external shipping portfolio of some $7 billion is by now larger than its domestic ship loan book. Most of the non-Japanese book is relatively low risk, concentrating on major corporate borrowers and project financing, with an emphasis on sectors where longer-term charter cover is available. One might say that the bank has so far tended to approach international shipping finance with a typically Japanese frame of reference, which is understandable enough. SMTB's international shipping loan book is currently smaller, probably less than $2 billion out of a total portfolio of around $10 billion, but it has established shipping finance units in Singapore and London and is seeking to build external shipping relationships which will resemble the long-standing ties it has in Japan with both corporate and privately owned shipping companies. The motivations for Japanese banks to internationalize their businesses are fairly obvious, given the demographics of the country, the high liquidity balances in the Japanese corporate sector, and the persistently low interest rate environment, exemplified by the descent of the yield on the 10-year Japanese government bond to record negative levels. This has led not just to organic growth overseas, but also a number of acquisitions of businesses offered for sale by foreign banks which are under pressure to shrink their balance sheets. Looking specifically at shipping finance, it may at first sight seem strange to look for growth opportunities in an industry which is currently plagued by overcapacity and by extremely severe financial stresses in the dry bulk and container shipping sectors. However, a contracyclical approach can produce superior returns over the long term, and the current state of the shipping finance market offers perhaps the best timing for a controlled growth strategy compared with any other period since the late 1980s. In the first place, ship values in both the new building and second-hand markets are at low levels, exceptionally so as far as bulk carriers and container ships are concerned. So lending to credit-worthy ship owners at prudent loan-to-value ratios now offers a substantial margin of safety, in contrast to the sort of reckless competition at high LTVs which characterizes cyclical highs. In the second place, shipping loan margins, which have generally been too low relative to shipping risk for most of the past 50 years, are currently at reasonable levels. Top-tier borrowers can command spreads below 200 basis points, but the majority of ship lending today is in the 200 to 300 basis point range, which compares well with most asset financing sectors. Most important of all, the withdrawal and retrenchment of numerous banks, which have been major lenders to the shipping industry over the past 20 years, offers a rare opportunity for Asian lenders to step into the breach and expand their ship loan portfolios on a selective basis. Availability of bank shipping finance has not only shrunk since 2008, but those banks still active in the market have tended to compete for the same top-tier business, leaving large numbers of highly creditworthy, small to medium-sized shipping routes relatively starved of external capital. This opens up an exceptional opportunity for well-capitalized and tightly managed lending institutions to acquire high-quality relationships in the shipping sector and build a strong platform for future growth. Of course, where shipping finance is concerned, there are always risks and plenty of pitfalls lying in wait for the unwary. In recent years, we have seen a number of ship finance startups aiming to take advantage of a perceived contracyclical opportunity, as well as the influx of credit funds seeking to acquire portfolios of shipping debt at a discount. Most of these have had a poor experience. Shipping startups have tended to chase lower quality business at high spreads because their cost of capital is too high for them to do business at 300 basis points with credit-worthy counterparties. This is a surefire recipe for loan losses and capital destruction. Credit funds have often believed they were acquiring debt at an acceptable discount, only to discover that they are sitting on LTVs of well over 100%. These errors should be easily avoidable by established major Japanese lenders with an extremely low cost of capital and well-developed credit controls. As the shipping finance market goes through its greatest transformation since the 1960s, it would be unfortunate indeed if the Japanese banking industry were not prominently represented in the new hierarchy of international lenders. Thank you.